Welcome to this Masterclass Explainer. Today, we're going to fundamentally dismantle one of the most destructive habits in retail trading, price watching. If you've ever felt like you're constantly chasing the market, always arriving just a second too late, and basically just providing exit liquidity for the institutions, well, this explainer is going to shift your entire perspective. Let's dive right in. I want you to ask yourself this directly. Why are you always late to the trade? You know the exact feeling I'm talking about. You wait for a level to break, you wait for that perfect price confirmation, and the very moment you enter, the market reverses. You suffer an immediate drawdown. Why does that happen? Because you're relying on lagging information. You're looking at where the market has already been, not where it's actually going. So here's exactly how we fix that today. First, we'll cover the physics of markets. Second, the 3 pillars of change. Third, the acceleration entry framework. Fourth, filtering with institutional flow. And finally, the psychology of being early. We're going to move methodically from foundational market philosophy right into strict rule-based execution. All right, part 1, the physics of markets. Let's completely deconstruct the ultimate trading mistake, staring at price instead of anticipating market flow. You see, most beginners just watch price. They sit there and look at the numbers flicker. But price, it's literally just a static snapshot of the past. It's the absolute last piece of information to update in the market. Change, on the other hand, is like a dynamic video of the future. Information flows in a very specific sequence. First, smart money initiates change. Then, market structure shifts. And finally, price actually confirms it. If you're waiting for price, you're dead last in the information hierarchy. You're essentially just volunteering to donate your capital to the institutions that started the move in the first place. To really grasp what change means in trading, let's borrow a bit from the laws of physics. Think about driving a car. Price is your position. It's exactly where you are right now. Velocity is the rate of change, or how fast you're moving. And acceleration, that's the rate of change of the rate of change, meaning are you speeding up or are you slowing down? If you want to know where a car is going to be in 10 seconds, just knowing where it is right now isn't going to cut it. You have to know its acceleration. In markets, measuring these derivative metrics gives you a significantly earlier signal than merely watching where the price happens to be sitting. Okay, moving on to part 2, the 3 pillars of change. Let's look at the core metrics we use to quantify this market physics and actually spot those institutional footprints. There are really 3 types of change that matter here. First up is the rate of change. Specifically, we use a 14-period ROC. This acts as our primary directional signal, kind of like our speedometer. When it crosses the 0 line, the short-term trend direction has officially changed. Second, we look at volatility change using an expanding average true range, or ATR. Markets constantly cycle between contraction and expansion, right? Well, the ATR tells us when an explosive range expansion is brewing. And third is volume change. Volume confirms participation. If price moves but volume doesn't, it's just noise. But when all 3 of these pillars align, you have a massive, massive edge. But listen, here is exactly where traders get trapped. To avoid fakeouts, you absolutely must differentiate between a volume climax and an institutional volume surge. If you see extreme volume, we're talking like 3 times the average, but the candle closes with a massive opposing wick, that's a volume climax. It's a total fakeout. It shows exhaustion, which means smart money is just absorbing retail panic. What you actually want for a valid change signal is a volume surge. That looks like a steady 1.5 to 2.5 times the average volume, closing near the extreme of the candle. That right there signals genuine continuation and a real institutional backing. Which brings us to part 3, the acceleration entry framework. Think of this section as your uncompromising checklist for flawless trade execution based on change acceleration. We're going to apply the change acceleration framework to identify our exact entry triggers. Here are the mechanical rules. For a long setup, your 14-period ROC must cross above the 0 line. At the exact same time, the volume on that crossover candle has to be greater than 1.5 times the 20-period average. Next, price must close above the 20-period moving average. That ensures we're aligned with the trend. And finally, your entry is only triggered when the price actually breaks above the high of that signal candle. For a short, it's the exact inverse. And please hear me on this. Missing even one of these layers means no trade is taken, period. This is a highly repeatable entry strategy, but it requires absolutely 0 compromise. Now, before we lock in those entries, we need to quickly touch on divergence. You're going to notice times when price makes a lower low, but your rate of change indicator makes a higher low. That's a bullish divergence. But here's the kicker. Divergence is a warning, it's not an entry signal. It's just telling you that momentum is weakening and a zero-line cross is probably right around the corner. You use it to anticipate the cross, sure, but you still wait for your entire checklist to trigger before putting a single dollar of capital at risk.
All right, part 4, filtering with institutional flow. Let's add some macro context here so we don't end up trading against the structural flow of smart money. To do this, we integrate the COT change confirmation matrix. We use the weekly commitments of traders, or COT data, as a mandatory filter. See, the acceleration framework tells you when to enter, but the COT report tells you what the broader market structure actually supports. So if your ROC crosses above 0, giving you a bullish signal, but the COT bias is strongly bearish, you skip the trade. 0 position size. The structural flow is completely against you. But if both align, that's a strong long, and you go in at 100% position size. This matrix is huge. It validates your directional bias and dynamically adjusts your sizing to keep you protected. Let's look at how this plays out practically with a recent gold case study from May 11th. So the COT bias was strongly bearish. Because of that, any long setups earlier in the week were completely ignored. This saved our disciplined trader from taking unnecessary losses on false rallies. The trader just waited patiently. Then, on May 12th, it happened. The ROC crossed below 0. Volume surged right into that sweet spot, between 1.47 and 2.0 times the average. Price dropped below the 20 MA. Everything aligned perfectly. The result? A beautifully executed 3.0 R win. Having the patience for institutional COT alignment is what sets up high-probability entries and preserves your capital. And finally, part 5, the psychology of being early. This brings us to the biggest, most overlooked hurdle in this entire masterclass, your trader psychology, and the sheer mental friction of trusting a change-based system. Think about it. When you enter on a rate of change crossover, the price hasn't technically broken out yet. You are entering before the crowd sees the obvious price confirmation, and human nature absolutely hates that. It feels incredibly uncomfortable, but you have to reframe that discomfort. The discomfort is the edge. If it felt comfortable, everybody would do it, and the edge would vanish overnight. That extreme discomfort you feel entering a trade before price confirms it, that is the exact mathematical edge you need to secure massive reward-to-risk ratios. If it felt safe, the crowd would already be in. So how do we overcome this mental block? You have to adopt a highly disciplined approach to building your patience muscle. Remember, this specific strategy is only going to give you 2 to 5 highly qualified signals a week. First, define your signal precisely so there's absolutely zero ambiguity. Second, use platform alerts. Let your computer watch the ROC line for you so you aren't just staring at charts all day, getting tempted by the noise. And third, track your patience in a trading journal. Write down every single time you waited for all the rules to align versus the times you took an impulsive, early trade. Which leaves us with one final thought to close out this explainer. Are you ready to stop being exit liquidity for the smart money? The crowd waits for price confirmation. They enter late, with wide stops, providing the exact liquidity the institutions need to comfortably exit the early positions. But you have the framework now. You understand the physics of velocity and volume. You know how to align with that COT flow. It is time to stop observing the past and start anticipating the future.